Hi, everybody. We've currently got about 40 people on and about 100 have registered. So we'll wait a little longer before we start. Um, a couple more minutes. Okay, everybody. We just hit the 50 mark, so I think we'll start, and the others can catch up. We will be sending out a copy of uh, the seminar after this, sometime later today. So I'm Peter Hirsch. I think most people know me, and a number of people will know Andrew, who is joining us afterwards from Pioneer Wealth. I will start, and then Andrew will take over. At the end, we've had some 50 questions sent to us prior to the seminar, and we will try and go through those. Both Andrew and I will try and answer them as we're going during the seminar, but I'll quickly go through them afterwards, as will Andrew, and we'll make sure that if there's something we didn't pick up, we will. And please feel free to throw questions in the Q&A. For those who said hello, hi. Okay, so let me share and make sure this works properly. Okay, so let's begin. For some reason that's over there. Okay, so the presentation, for those who've heard of it, is it's in its similar format. I'll be going through things. Some things I'll just skim through, others I'll spend a little more time on because they're a little more important. So the first thing to talk about is residency, and when you stop being an Australian resident and become an Israeli resident. For those here in Israel, you may have noticed there was an announcement from the Israeli Tax Office on tax residency that was released in the last few days. That announcement is the default position. It is not the legal position. It's the easy way for you to decide how you're a resident. And that's based on the old-fashioned more days in Israel and less days overseas. That is not the technical answer. And you should always remember that residency is based on the double tax agreement. Where there is a double tax agreement, that takes precedence over local legislation. So if Israel was to legislate a change or Australia to legislate a change, without changing the double tax treaty, nothing changes. So we need to remember that you become a resident, or you stop becoming a resident of Australia and become a resident of Israel when, um, better put, let me rephrase that. You stop becoming a resident of Australia when you become a resident of Israel. And you become a resident of Israel when you change your place of domicile from Australia to Israel. And that happens where your center of life moves. Now, in most cases, that's simple. It is, you've sold your home, you've taken all your assets, you've pulled your kids out of school, you've cancelled all your memberships and everything else in Australia, picked up, to talk in Australian terms, you've picked up your stumps and you've moved them to Israel. You then will become an Israeli resident when you walk, technically, when you walk through the gate into the baggage carousel. That's the point of time where you change. Now, a lot of times it becomes more complicated than that, where people are spending half their life in Australia, half their life in Israel, or some of their life in one place and some of the other, or they're talking about moving short term. They're specific instances, and we need to look at them specifically. So, in those cases, you're going to need specific advice. So just be aware of that. Okay, now let's talk about the way in which income is taxed. So you are you've left Australia, you've moved to Israel, and you still have some assets in Australia. As far as Australia is concerned, they will still want to tax some of those assets and some of the income on those assets. So as far as dividends are concerned, if you're receiving a franked dividend, that's tax-free in Australia. If you receive an unfranked dividend, you will pay 15% withholding tax, and that will be deducted by the company before they give you the dividend. With interest, there is 10% withholding tax. If you see anywhere 15%, that only applies for countries that don't have a double tax treaty. There is a treaty here, so the rate is 10%. Again, that's deducted by the bank at source, and you get the 90%. So that's the tax in Australia. Trust distribution. So if you're earning income from a trust, the trust will in fact be taxed on your behalf. It will receive an assessment and pay tax at non-resident income tax rates. Superannuation funds remain Australian super funds, so the actual income of the fund is taxed as it would be. So if pre-retirement at 15% on income, 10% on, 15% on income, yes, and 10% on capital gains. If you're in pension mode, the income will be exempt. The pension itself, assuming you're receiving that after retirement age, will be tax-free in Australia. And we might as well deal with this now. It will be tax-free in Israel during your 10-year period. That's definite. After your 10-year period, it should also be tax-free. That's the advice I have. And that relates to some very early legislation that Israel brought in that says that if a pension is not taxable in a foreign jurisdiction, it's not taxable here. Salary earned by an Australian employer. Now, this is very important, and we've had a couple of questions on this also. If you are making aliyah and you're currently employed by somebody in Australia and you're going to continue to be employed by them, you no longer are an employee for Australian tax purposes once you move to Israel. The double tax treaty makes it very clear that you are taxable in Israel on that income. So your employer, in inverted commas, should stop deducting withholding tax. They should stop paying superannuation in respect of you. They don't pay withholding workers' compensation insurance. They don't pay payroll tax in respect of you. You pay tax in Israel on that income. Very importantly, so you'll need to lodge a tax return here in Israel. Now, in terms of lodging returns in Australia, I said earlier, if you earn dividends or interest or a trust distribution, they're taxed. Either, as I said, the interest will be taxed by the company paying the interest, the withholding tax for the dividends by the company paying the dividend, the the trust is taxed itself. But you have to lodge a tax return if in your own name you receive rental income, you sell a capital asset that is taxable in Australia, so property in Australia, or if you had a student loan debt. And if you have a student loan debt, you must lodge a tax return in Australia. Okay, so that covers what happens here. Sorry, what happens in Australia. We've talked about this. We've talked about the salary. So I've covered that. When you get these notes, I've put in them the tax rates in Australia and the tax rates in Israel. This is tax on passive income, and this is tax on active income. Interestingly enough, if you look at the figures I have here in red, you'll see that until you get to very high tax rates, or higher taxable incomes, the tax rate in Australia is higher than the tax rate in Israel. And that's because the VAT rate is so high here in Israel. Okay, Australian capital gains tax. Um, we need to split this into three, and maybe I'll hit on four separate types of assets. So if we take the easy one, you own a investment property in Australia, you own shares in Australia. You'll be aware that as an Australian resident, you get a 50% discount if you hold those shares for more than, hold that asset for more than 12 months, and you then sell it on the capital gain. So your effective rate of tax, even if it's a top marginal tax rate, is about 23.5%. When you become a non-resident, once you become a non-resident, you lose that 50% discount, but you only lose it proportionally for the period you were a resident against non-resident. So if you hold an asset for 10 years, 5 years as a resident, 5 years not, then for 5 years or half of the gain, you will get a 50% discount and the other half you won't. Simple stuff. So the longer you hold an asset in Australia as a non-resident, the higher that tax rate's going to become, the way that formula works. So you just need to remember that as you're making your investment decisions. Your home, however, your sole and principal residence is a totally different situation. There, Australians get an exemption from capital gains tax on their sole and principal residence. The government introduced legislation a few years ago now, which says that if you sell that as a non-resident, you are subject to capital gains tax on the whole of the gain from when you originally purchased it to when you sell it without the 50% discount. So if you've made $1 million gain and you sell before you leave Australia, and sale date is date of exchange, not settlement. So date of exchange. If you exchange contracts before you leave Australia, there'll be no tax on your home. If you wait till afterwards, there'll be tax. And we're talking about, particularly for those of you living in Sydney, that could be $1 million, $2 million, quite easily. If you've owned a home for quite a while in Sydney, that's a very easy situation. So it is vital that people sell their homes, or at least look at selling their homes. There may be examples where it's not applicable before they leave. There are a small number of people, and I can pat myself on the head and say I'm one of them, who bought their homes prior to September 1985. So reminding you that if capital gains tax was introduced on the 19th of September 1985, and any assets owned prior to that were grandfathered, or I think they now say grandmothered, but it was they're not included in the capital gains tax rule, and that still is the case. So for those people who have owned their homes for quite a while, that's not an issue. You do not need to sell. Now, the last area I wanted to talk about was, oh, second last, sorry, is property owned outside of Australia. So those people who have bought property in, for instance, have a property in Israel that they bought 5 years ago. They're now making Aliyah. Australia will want to tax that property when you leave. So when you leave, you must pay capital gains tax on the value of the property or on the increase on the value of that property in Australian dollars um, uh, at Australian tax rates with the 50% discount. That happens in the tax return that you lodge immediately for the year in which you left. So if you leave now, today, it'll be the year ended 30th of June, 2026. The last thing I wanted to mention is I said earlier that if you own shares in Australia, they remain subject to capital gains tax in Australia. And the interest is subject, sorry, the dividends are subject either to withholding tax if they're non-franked or no withholding tax if they're franked. If that property, if those shares, however, are bought by you after you leave Australia, they are not subject to capital gains tax in Australia. The way international tax works, you are only subject to capital gains tax in the place in which you are a resident. So there's a little advantage there, particularly if you are going to receive the 10-year exemption from income chutz la'aretz when you arrive in Israel. You then have a situation where, so one trick might be, let's put it this way, you've got some shares, sell them before you leave, realize the capital gain, pay the tax. You then buy them back or similar shares back after you leave. At that point, those shares will not be subject to capital gains tax in Australia or Israel for 10 years. You will, however, need to remember that you are taking an exchange risk. And Andrew and I will be talking about that as we go a little further through this. Okay, there's some more detailed notes in the seminar on how that all works. Okay, buying property in Israel is similar but not the same as buying property in Australia. I think people need to consider that. I know a number of people are looking at buying property before they make Aliyah, and other people are even buying property despite the fact they're not going to be making Aliyah. They're buying an investment property in Israel or a holiday place in Israel. You need to think this through. The considerations you need to look at. One is the availability of properties. Unfortunately, that's been reduced now because there were quite a number of properties damaged in the 12-day war, which need to be replaced. The crane is still the native bird of Israel. So you don't travel anywhere without seeing a lot of cranes. There's a lot of property being built, but it is not, there is a perception that that's not going to be enough. The other point I would make is that, particularly here in Jerusalem, I found that each new property seems to be that little bit smaller. So something that was made, a Tama project, a rebuild project that was done 5 years ago, you might get a 110 square meter unit. Something that's done today is starting to get below 100. And that's simply because the builders are taking advantage of it. These things are going to be at the same price. You're just getting a smaller property. The other thing to look at is the conversion rate between the shekel and the dollar, and I'll talk about that in a moment, and I'm sure Andrew will spend a bit of time on that as well. Um, Purchase tax is very important. Purchase tax is what we in Australia call stamp duty, and I'll go through the rates there in a moment. And the Australian capital gains tax is something I've mentioned to you already. If you work through the numbers, though, if you expect the property to go up in value, do not be frightened about buying something in Israel because of Australian capital gains tax. Because the Australian capital gains tax, even at top marginal tax rate, will be 24%. If the price of the property is going up and you don't buy now, you buy later, you won't pay the 24%, you'll pay 100% because you'll need to pay at a higher price. So um, do not be frightened about that Australian capital gains tax. It's life. It's just something to take into consideration. Okay. Purchase tax. In August of last year, Israel introduced new legislation that gave enormous concessions for purchase tax for new or new Olim. If you buy a property 1 year before you make Aliyah, 3 year, and that's or 3 years if it's a property being constructed, or 7 years after, within 7 years of making Aliyah, and that period's extended for the period of construction in that 7 years, or army service, you get concessional purchase tax, and this concession is enormous. So the normal rate of purchase tax is around the 8% mark, going up to 10%, as you can see on this schedule. This was the old rate under the rules prior to August. You can see that for the first 2 million shekel, there's no tax. It then goes to 0.5% up to 6 million shekel. Now, to translate that into dollars, or shekel, sorry, if you were to buy something for 6 million shekel as a non-resident, you're going to pay about 480,000 shekel purchase tax. If you buy that same property as a new aliyah, that the purchase tax drops to 20,000 shekel. And I'll let you all get up from your seats. That's a savings of 460,000 shekel. It's over $200,000. So that's an immense saving, and it is something to think about in your Aliyah process. Okay, bank accounts in Israel. The look, every country of the world have different pain points, and quite definitely Israel has very different pain points to Australia. One of the pain points is opening a bank account. It can take a period of time, a week, maybe even longer, for the account actually to get opened, and you will kill a number of trees in the process, in all of the paperwork that you'll be signing. Because it takes so long, I strongly suggest to people that they either open the account before they leave Australia, particularly if you've got enough time, do that, 6 months before you leave on that previous trip or something like that. But if you can't do that, and then make your appointment with the bank prior to leaving Australia. Now, during this visit, I've met with two of the major banks, and I have got some connections with both of them. So I'm happy to talk to people about and give them the names of various people they can talk to in respect of opening accounts. And I've had assurances that they will make sure that the account opening process is easy. One issue you should be aware of, and I'll come back to the things you'll need in a second, is that if you open an account in Israel as an Australian resident, so before you leave, you cannot have an Israeli credit card. You can have a debit card, but under Australian law, Australia does not allow Australian residents to have credit cards with with foreign banks. So you will need to have a debit card. For those people like me who are traveling backwards and forwards, the debit card actually works quite well. In terms of opening an account, you'll need your normal two IDs and things like that. I've mentioned that the time, etc. Let me just make sure I've covered that. And I've mentioned when you have if you open a bank account before you make Aliyah, once you come to Israel and you get your ID number, that bank account will need to be converted to an Israeli bank account. That conversion process is seamless. It just needs to happen. So you do need to tell your bank that you now have an Israeli ID. That will also stop that withholding tax issue that I mentioned earlier on interest. So it works the other way also. So just to make that clear, if you've got a bank account in Israel and you're earning interest on that bank account as an Australian, you'll have withholding tax in Israel at 10%, and you'll then pay income tax in Australia on the interest, and you'll get a credit for the withholding tax. Okay, superannuation. Just one sec. Okay, we need to talk about how super is going to be taxed in Australia and how it's taxed in Israel. But before I start, let me just say if you are under 65, and you've got money in super, I'm sorry to say you cannot take that money out of super and move it to an Israeli equivalent fund. It just doesn't work. That money must stay in Australia, and you should get advice as to how you hold that money and what you do with it. The important things to consider are if you're in a public fund and there's life insurance on that public fund, just make sure that life insurance will react if you die overseas. A lot of these insurance policies do not, and you may want to cancel the policy. Secondly, if you have a sizable amount in super, over $400,000, it may be appropriate to have a self-managed fund rather than being in a public fund. The issue with a public fund is you can't tell them where they're going to invest their funds. So they will invest them in Australian assets in the main. If you're in a self-managed fund, you can manage the investments, and you're then able to invest in shekel-denominated investments and reduce your exchange risk. So you want to look at that, but if you've only got small amounts in super, the financial cost of running a self-managed fund will not make it worthwhile. So you do need to get advice in that area, and it's something to look at. So for those younger people on the seminar, please get that advice and remember that the money is locked in super. For those older people with money in super, so if you have over $300,000, $400,000, $500,000 in superannuation becomes the best investment vehicle you can have effectively. Just like in Australia, the fund itself is tax-free. The fund by law is an Australian resident fund. It must be. Otherwise, it's not a superannuation fund. So it's tax-free 100% definitely for your 10-year period. And we're 90 something percent sure that that will be the situation for life. That's in terms of the fund itself. The pension, as I mentioned earlier, is tax-free. So for those people who are either close to or are in retirement age, my suggestion is to try and get as much money into super as you can, within limits though. And the important limit is a change that's about to happen. Where have I got those notes? There. Okay. The For those people who kindly voted Labor at the last election, thank you very much. Thanks to that, we're being told that a new tax is being introduced on superannuation funds. It's called a Section 296 tax, and it will have the effect of increasing the tax rate on the income of the fund for those amounts over $3 million by an additional 15%. So effectively, the fund's going to pay tax at 30%. And then when the money comes out of the super fund, you've also got you could have some money tax to pay. So all of a sudden, it may not be worthwhile to have money in super. The additional problem is that they're going to be taxing unrealized gains in the super funds. And that could cause a cash flow problem for you as well. This is a brand new area. We're looking at it, but it looks like best bet is to make sure you have less than $3 million in super when you at retirement age, both as an Australian and if you're coming here to Israel. In both cases, that makes sense. But quite so in terms of how much money to have in super, again, as I said, as much as you can, but try and stay below that $3 million mark. That will get your tax down. Make sure you're in a relatively tax-free environment for life. The notes in here explain how superannuation tax works. Most people understand that. But in terms of getting extra money into super, uh, if you get advice well before you're about to leave Australia, there is a good opportunity to get something like 700 or something around the $800,000 mark of additional money per member into super. And that comes about because there is a thing called a downsizer contribution. So if you sell your home, you can make a downsizer contribution. Interestingly enough, you can buy a more expensive home afterwards, but you can make this contribution of $300,000. You need to be over 55. You need to have owned the house for more than 10 years, but each husband and wife can make that contribution. So that's 300 each. Then you can make undeducted contributions in a year of 120,000. If you do it carefully, you make 120,000 in 1 year, and then in the next year, use the bring forward rules to contribute 360. That gives you 480 plus 300 is 780,000. So close enough to that 800 mark, so you can start topping up your super before you make Aliyah. And we've had instances where people had no super and were able to come here with between husband and wife over $1.5 million. So that is worth looking at and is one of the avenues to play with. Okay, exchange rates. And I've talked about this before. This graph here is of the shekel from 2012 to 2025. So you'll see in 2012, the shekel was, you got 4 shekel to the dollar. Today, it's 2.2 shekel to the dollar. Right? And that line, these lines are always wavy, but if you draw the line, it's going one way. And the concern is that that could continue. So if you continue to hold investments in Australia, you've got the downside risk that they will be worth less in shekel terms going forward. So it's something to think about. I've done the same graph here for the last 5 years. And the important thing is to look at the situation from about here, which is, say, October 2022, when the legal dispute started happening with government. And then you can see the shekel depreciated, that's October 23 when the war started. But you can see from October 23, when the shekel was 2.5, something like that, it's hit one high point here since then. But since then, it's come down dramatically. You can see here where the 12-day war with Iran, it hardly affected the shekel at all at the start of the war. But since the end of the war, the shekel has appreciated quite a bit. So the concern is that that will continue to happen. I'll let Andrew give you more details on that. But the last graph I wanted to show you is this one. I just went into AI and said, can you graph me the major currencies, including the shekel, against the US dollar, and show me which ones have appreciated against the US dollar and which ones have gone down in the last 15 years. And if you have a look at that, the euro, the German Deutschmark, the Japanese yen, the Australian dollar, all of these currencies have depreciated against the US dollar in that 15-year period. The only two currencies to appreciate were the shekel and the Chinese yuan. And remember that the Chinese yuan is a controlled currency, so they've just forced their currency up because they wanted to. The shekel is floating, and to be honest, we're aware that the Reserve Bank here in Israel is trying to keep the shekel down. And it's still the only currency in this basket, exclude the one, that has appreciated over that time. And there's good reason for that. This is a growing economy. The high tech's still happening. The gas is about to come online. The growth rate in population internally is the largest in the Western world. And the expected aliyah rate, particularly from Western countries, will also bring a lot of foreign currency into Israel. So this is a major concern, and it is something you need to think about as you're working out how you hold your investments after you make aliyah. I've just done some calculations there. Okay, trusts. For those that have heard my seminar, I normally start this by saying everybody hates Bibi. I'm now going to give you the real reason to hate Bibi. Today, not everybody hates Bibi, just most of the people, but not everybody. But this is still a reason to dislike him. Israel had a problem when Bibi was the finance minister. At that time, there were a number of wealthy Russian oligarchs who were moving to Israel and who have made money in Israel, who were moving assets offshore into foreign trusts. And that was a concern to the Israeli economy. They wanted to make sure that they could tax that. And the way in which they decided to do so was to use an elephant gun rather than a pop gun to solve the problem. And what they did was they said, if you have a trust that is based chutz la'aretz, and its assets are chutz la'aretz, and one beneficiary of that trust, and technically it's one potential beneficiary of that trust, is an Israeli, Israel can deem that to be an Israeli resident trust and tax the trust on any income that is not otherwise going to be taxed in Israel. So if there is a beneficiary that's Israeli, they're not going to try and tax the trust on the Israeli's income. It's only the income of the other people. The effect is that for a trust, let's say we've got a younger person making aliyah whose parents have got a trust. That trust distributes to that child in Israel and it distributes to another child who lives in Australia. The Israeli will just get taxed. They'll be taxed in Australia on the income. They'll pay tax as a non-resident. They'll then get a foreign tax credit in Israel and they'll pay tax once. The Australian, however, will end up paying tax twice. The trust will be taxed in Israel and the individual will be taxed in Australia. The effect is they'll pay tax at somewhere between 75 and 80%. So the advice I always get from Israeli accountants when I go to them and say, oh, I've got somebody making aliyah, they've got a trust, the first thing they will say is wind up the trust. The second thing they will say is wind up the trust. And when I tell them that you can't, they'll again say wind up the trust. When you can't, we then need to look at them very carefully. One option is to remove the Israelis as beneficiaries of those trusts. That may work, but then that causes problems with estate plans and the like. If people have trusts in their structures, or their parents have trusts in their structures, or their parents have set up testamentary trusts, that's trusts created by wills, in their wills, they need to get detailed, strong advice before you make aliyah, and very likely will need to restructure definitely before your 10-year period is up once you make aliyah. This is a real pain point and needs to be looked at and needs to be looked at carefully. Okay, so just reminding people that any trusts, get advice, go and see your own accountant and your own lawyer, make sure and if they come back to you and say, we don't understand this, we're not sure what's going on, get them to speak to me, and we can work together to try and solve these issues. But they need to be solved. Do not do a three monkeys, see no evil, hear no evil, speak no evil. Do something about it. It is it's a big issue. And I should just remind people about the 10-year exemption period. Right now, if you make aliyah today, you have a 10-year exemption period from paying tax on income earned, passive income earned, chutz la'aretz. You also have an exemption from reporting that income. If, however, you make aliyah after the 1st of January 2026, you will need to report that income to the tax office here in Israel. You do not pay tax on it for the 10-year period, but you have to report it. So the tax office will be aware of your trust arrangements and will be looking at it once you get close to that 10-year period. So important things to look at. Anybody with trusts, please look at it and try and sort those things out before you make aliyah. Okay, so that's this area. Now, for those people who have residential property in Australia, there are a number of tax issues in Australia on that residential property. So these issues only apply to non-Australian citizens who are non-residents of Australia. But Remember that if you're making aliyah, your kids may not marry Australian citizens, and properties that you may own may end up in your children's hands or their spouses' hands or their children's hands. And so this is something important to remember. And not everybody making aliyah from Australia is actually an Australian citizen. Some people were just Australian residents. So remembering that there is penalty land tax and penalty stamp duty on properties that you own in Australia. We're nearly there, Andrew. So the seminar's got the rates of the penalty tax. So you're aware of them. If you do own property, it is something to consider. Again, get advice so you understand what your tax will be. Interestingly, there is a new federal tax in addition that has just been introduced, and a requirement for foreign persons to lodge a vacancy fee return if you own property in Australia and it's not being rented out. Again, this only applies to people who are not Australian citizens, but it is something important to consider. So that's somebody who's on a temporary visa holder, for instance, this will apply to, and you will need to do this. So it's important to remember. The last thing I want to mention is student loan debts. If anybody has a student loan debt, that student, you must lodge a form with the Australian Tax Office within 7 days of leaving Australia to say that you have that foreign debt and that you will no longer be an Australian resident. And you are required to lodge tax returns in Australia from that point on. There you have to lodge tax returns on your worldwide income. And if your worldwide income goes over the threshold, you have to start repaying that debt. For those in Australia who will be aware that the debt's just been reduced by the Labor government, it may be a good time to pay off those debts before you leave if you can. If you can't, please make sure that you comply with the rules. If you don't, you could find yourself having some major tax bills on that repayment because the penalties are large. So that's that. And I think, yep, that's it. That's all I really wanted to talk about. I'll now hand over to Andrew, who will talk about the investment side. And after that, we'll try and go through the questions that and make sure that we've covered everything. So Andrew, over to you.
Right. Thank you, Peter, and good afternoon to everyone who's watching this from Israel, and good evening to everyone who's watching this in Australia. Peter, if you can just take your slide off, then I can share my presentation. Great. Hopefully everyone can see that. Just wanted to welcome everyone to the webinar. My name is Andrew Album, and I'm a financial consultant and senior wealth manager here at Pioneer Wealth, based in Herzliya, Israel. Made Aliyah nearly 18 years ago, so I've been here for quite a while now. Today's presentation is going to cover a number of issues. A couple of housekeeping points first, just to point out that Pioneer Wealth is regulated by the Israeli Securities Authority. We are a significant firm here in Israel. I'll tell you a little bit more about us shortly. I'm also qualified and a member of the Australian Institute of Chartered Accountants. For my sins, I married an Australian. She's a Carlton fan, so she's definitely not too happy with how the AFL table's looking so far this season. So that's not a subject she wants me to cover in the presentation today. What's the job of a financial planner? What's the job of a wealth manager? And how is that particularly relevant or important if you are making Aliyah or you've made Aliyah already? And I would suggest to you that the headline to be thinking about is that what was familiar to you and what was correct advice to you when you lived in Australia may well no longer be the case. Aliyah changes a lot in many aspects of our lives, and those of you watching who are here in Israel will know that already. For those of you who haven't yet made Aliyah, it's really important to understand there's going to need to be a shift in your thinking in many areas, whether it's expecting to queue patiently in a queue that nobody jumps in front of you for, that the banks are quick, super, and efficient, or how to manage your money, how to plan your finances, and how to achieve financial security here in Israel. So I feel that my job for my clients in Israel is to think about the risks that they perhaps weren't fully aware of because they largely didn't apply when they were living in Australia, and to understand how they could impact financial security here in Israel and how to address, alleviate, or reduce them as much as possible. We're not going to talk today about how to get rich quick. We're going to talk about what the risks are that you need to be aware of, what you need to be thinking about, and how you can mitigate many of those risks with careful planning. And the 6 risks I want to talk about today are currency risk, asset allocation risk, taxation risks, repatriation of capital risk, advice deficit risk, charges, and then touch briefly on some next generation planning issues that I know many Olim don't think about. Let's start with currency. It's something that Peter touched on, but it's perhaps the #1 challenge that faces Olim from Canada, from the UK, from Australia, from South Africa. You need to think about the fact that when you lived in Australia, your income and assets were denominated in the Aussie dollar. Your expenses and liabilities were in Australian dollars, and therefore they matched. Once you make Aliyah, if you're in a situation where your income and assets are mostly or entirely in Australian dollars, and your liabilities and expenses are in the shekel, you're going to have a significant mismatch, and that mismatch creates a risk that never previously existed, and it's a large risk. And to recap the slide that Peter put on a bit earlier, the Australian dollar has, there's no other word for it, collapsed in value against the shekel and lost about 40% of its value over the last 15 years or so. From 4.2 shekel to 1 Australian dollar, the current rate is 2.2 shekel to the dollar. Now, one approach is to bury your head in the sand and hope that this problem will go away and the Australian dollar will stage a recovery. Unfortunately, most experts don't think that will be the case because the key factors that have driven the shekel higher and higher against all major currencies over the last 2 decades are still intact, they're still there, and they're still pushing the shekel up. And as the uncertainty caused by the horrific war of the last year and 3 quarters, please God, subsides, those factors will come to the fore, political risk will disappear as an issue, and most experts predict that the shekel will continue to get stronger. So you have 2 options, one of which is to hope, and the second is to plan your finances in a way that controls and reduces that risk. Currency risk is without doubt the #1 risk facing many Olim. And it goes without saying that there is one currency that has not lost anything against the shekel over the last 20 years, and that is the Israeli shekel itself, of course. So if you construct your investments that you have exposure to the shekel, then you have matched your assets and the income it generates with your liabilities and expenses, and you've reduced or eliminated exchange rate and currency risk from your financial plans. The second big risk is what's called asset allocation risk. And what that really means is a poor investment strategy that is not fit for purpose for life after Aliyah. And many Australian clients that I have and Australians that I speak to suffer from what's called home country bias. It's not a uniquely Australian issue because many Canadians and Brits and South Africans do it as well. But they have far too much money invested in assets in their home or former home country than is appropriate from a global perspective. Globally, the Australian stock market accounts for less than 2% of the global market. So if your super fund or your portfolio is full of Australian shares at more than 2% of your portfolio value, you're effectively taking a huge risk on the Australian stock market. And let's be honest, over the last decade and more, it's been a poorly performing, underperforming market because the market largely consists of banks and insurers and miners and commodity stocks, none of which have the capability to provide genuine growth over time. So that risk is not only an unnecessary risk when you make Aliyah, but if you're already here and you've retained that exposure to Australian assets, you've doubled down on a poorly performing market. And that really extends also to holding real estate assets back in Australia, because the Australian economy is not a fast growing dynamic economy. It's again commodity based. It's getting stuck into a low growth environment with high government spending. That's not a place to get the best returns potentially from your assets going forward. It's really important to focus on the old rules, the age-old rules which still apply of diversification and spread, but it's as important when you make Aliyah to detach yourself from this bias to companies and names and properties that you know and are familiar with, which from an Israeli perspective and a life in Israel perspective are largely irrelevant and create unnecessary risks. You can see, for instance, over the last 15 years, the return from the US stock market has been almost double the total return of capital gain and income from the Australian market. And over a shorter period, say 5 years, the Israeli market has significantly outperformed the Australian market. And remember, the last 5 years in Israel were dominated by 12 months of or 10 months of protests about judicial reform and 20 months of war with Hamas and our neighboring proxies of Iran and Iran itself. So for most of the last 5 years, Australia has been in a benign economic environment. It's been the lucky country which should have prospered as such. For much of that same period, Israel has been mired in war and all sorts of other complications and problems and economic challenges. And yet, Israel has significantly outperformed Australia when it comes to stock market returns. The third risk is taxation risks. I've spoken about, and Peter's spoken a lot about tax. It's important you know your tax obligations in Israel and abroad. It's important you think about the taxes you're incurring on things you leave back behind in Australia, such as taxes on superannuation. And you remember that as an Oleh Hadash or Hadasha, you will be entitled to 10 years of tax-free returns. So paying some tax in Australia is an absolute cost that could potentially be completely avoided by careful financial planning. Another thing to think about when you come to Israel is something known as US alien non-resident estate tax. This is a death tax, an inheritance tax, and a tax on estates paid by anyone who has US assets. So if you're holding shares in Microsoft or Meta or Google or American stock market funds or American property, when you're in Israel, you may create for yourself a liability to US estate tax. Taxation planning is important. Taxation risks can be consequential. Bringing capital into Israel, and Peter spoke about banking, etc., can also be a challenge. Israeli banks are very strict about source of funds, money laundering, ensuring tax compliance, largely as a consequence of the very lax approach they took sort of 5 to 10 years ago and further back than that. And what that can mean for people who make Aliyah that's often not thought about or carefully understood is the longer money is left outside of Israel, the more difficult and challenging it is to bring it into Israel later. Too many people end up with capital stranded offshore, which they or their beneficiaries are ultimately unable to bring into Israel. Very important to think about that. If you bring your money to Israel, it can be very securely held, and you avoid the problem of trying to bring the money later and proving where it's come from. Really, really important is this issue of who's going to look after you and guide you through the rest of your life after you've made Aliyah. Of course, lots of Olim from the English-speaking world have an advisor back in the country where they came from. They've got an affinity, they've got a loyalty, perhaps they want to stay using that advisor. But over time, this can become much, much more problematic. Firstly, that advisor cannot visit you in Israel. And financial planning is not a job done by a machine, a robot, or an AI computer. It's a personal relationship based on personal contact and face-to-face advice. So yes, maybe in the early years, Zoom will cope, the occasional trip back to Sydney or Melbourne, and you can see your advisor and catch up then. But over time, that's not a realistic strategy. Firstly, some countries like the UK and Canada are making it increasingly difficult, if not impossible, for local advisors to continue to advise clients who live overseas, including in Israel. So if Australia follows that global trend, you may end up finding the Australian advisor isn't able to advise you anymore. Secondly, the older you get and the more remote Australia becomes, the higher the probability that at some point the advisor you had that relationship with will retire or move on, and then who are you going to create a new relationship with? You can find yourself in a position where you have no access to advice. You need advice in Israel from advisors based in Israel who can come and see you when you need, and you can go and see them when you need, and who will remain up to date and knowledgeable about all the aspects, the Israeli tax and financial planning aspects of your wealth management, not just specific Australian ones with no understanding of what the situation is here in Israel. It's really important to think about who's going to be advising you and your spouse and your family for the rest of your life and beyond once you've made Aliyah. Always important, of course, to think about charges and costs. All I'll say for now is, as I'm sure anyone who's made Aliyah on this webinar knows, and those of you that have perhaps been to visit Israel know, certain things in Israel are expensive. But one of the things in Israel, interestingly, that's not expensive is professional money management. And many people are surprised positively that actually the costs of having money managed here in Israel can be far more reasonable than the level of fees that they're used to. The final thing just to think about is next generation planning. I've touched on that specifically with regards to advice and the advice you use and the advice you're getting, but it's also about thinking about how your spouse and more importantly your children, if they live in Israel, are going to be able to manage and look after the assets that you'll ultimately bequeath them. Again, rental properties in Sydney or Melbourne might seem like a good idea today. In 20, 30, 40 years' time, can Israeli raised children or grandchildren look after those properties effectively, manage those assets to maximize returns? Are you leaving them an inheritance, or actually is it more of a millstone? And I've met people over the years, and I've been advising clients now for over 3 decades, people who inherit assets that are for them a nightmare rather than some great inheritance. Really important to think about all the aspects of next generation financial planning. It's very, very important to not let the tax tail wag the investment dog, to use a very old financial planning adage. Yes, there are tax advantages in super. Yes, there are tax advantages perhaps in trusts, although as Peter has explained, that's often not the case anymore for Australians with trusts who make Aliyah. But it's important to think holistically and think comprehensively and think about all the aspects of your financial planning and not just make tax-driven decisions, because decisions made purely on the basis of tax can be huge mistakes. And I've shown already, and echoing some of the things in Peter's presentation, an Australian super fund, for instance, might come with tax benefits, but the return on Australian assets, be they property or equities or bonds, has generally been poor compared to other major markets. And the Australian dollar has depreciated significantly against the US dollar and against the Israeli shekel. So from a tax perspective, maybe it seems like a good idea, but when you take it on a more comprehensive view and a more thorough analysis, you can see that a tax-driven decision is often a poor decision. So it's very important not to let the tax tail wag the investment dog. It's very important to think comprehensively. Here are some ideas I want to share with you that may be relevant to you, and it's something we can discuss on a one-to-one basis after the webinar. So the first is, if you have a self-managed superannuation fund or a fund that you can convert into a self-managed fund and it's significant in size, maybe the best solution all round is to have proper investment management of your super fund denominated in US dollars with a local asset manager here in Israel that can provide you advice and guidance on how best to structure the portfolio, how to manage the portfolio over time to maximize returns and control risk, and to be there to support and guide you through that whole process. And it's possible to retain an Australian super fund, a self-managed fund, appoint custodians based in Switzerland or the Channel Islands, and then have the portfolio managed on a global basis without the currency risk of too many Australian dollars, without the asset allocation risk of too much Australian assets, and without the advice deficit risk of not having an advisor managing the portfolio here in Israel who understands what's correct for someone living in Israel from an investment strategy perspective. So that's one option, and that's something that here at Pioneer Wealth we do for clients. The second option is to think very hard about assets outside of your super, maybe even drawing some of your super money and taking it out to allow you to deal with the currency risk issue that you face by building a shekel portfolio. This can be a global portfolio, including US and other shares and assets, as well as local assets, where everything is hedged into and denominated in shekel. And that way you can have assets and income in shekel to match your expenses and liability in shekel and eliminate exchange rate risk from a part of your wealth to give you greater financial security and greater peace of mind. At the moment, having managed portfolios in shekel is more challenging, but it is something that we're actively looking at the moment for clients of ours here at Pioneer. Really important then to review your current strategy and think about what you should be doing better and smarter and more intelligently once you've made Aliyah, or if you've already made Aliyah, now that you're living here. So let me finish by just telling you a little bit about Pioneer Wealth, who are considered one of the leading wealth management and advisory firms here in Israel. And I think what's special about Pioneer is a number of things. Firstly, we're able to manage, as I just said, global assets in a global portfolio for self-managed superannuation funds for Australian clients. You're not going to find really hardly anyone else, if anyone at all in Israel, who can do that for you. Pioneer is also stand out in terms of the fact that we have two separate investment management teams, both hugely experienced, both with considerable knowledge, and both focusing exclusively on different areas of investment. The first is our global investment management team. The second is our shekel investment management team. We're managing individual portfolios for clients globally in shekel, globally in US dollars. We're regulated by the Israeli Securities Authority. That gives considerable comfort and peace of mind to all of our clients to know that we're regulated, we're supervised, everything we do is above board and proper. We're a firm with scale, not a 1, 2, or 3 man or 3-person outfit running from some corner shop on a high street. We are one of Israel's leading wealth managers. The way we run our portfolios ensures a total alignment of interest between ourselves and our clients. with no conflicts of interest. What does that mean? We get paid nothing to buy, we get paid nothing to sell. If there's a commission on an investment that we choose, we are contractually obligated to repay that money to clients. All we charge is a percentage annual fee, which means there's never any concern that the objectives of the investment manager can diverge from the objectives of the client. We're all swimming in the same direction, having clients who are happy for the long term with good performance. And that's the only way that we get remunerated. And that's, I know from my own experience over all these years, what makes clients happy. All of our clients also benefit, whether it's superannuation money or personal money, from independent custody, which means that your money is secure and ring-fenced in the event of anything happening to Pioneer, precludes any risk of theft or fraud, and also actually it's ring-fenced if anything was to happen to your custodian bank, because they do not own the assets that are yours. They remain yours at all times. And finally, and most importantly, we report in English, all your valuation statements are in English, meetings are conducted in English, communications from Pioneer are in English, and you will have a personal wealth manager, qualified, licensed, and experienced, based here in Israel, not 10, 12,000 miles away, not with a 7, 8, 9, 10-hour time difference, here in Israel to guide you, to be with you for every stage of the journey. That is something that I know from all my time in this industry is absolutely priceless. So that's my presentation. Peter, I don't know if you want to rejoin us and we'll handle or go through any questions. I'm conscious that we've been speaking now for over an hour. So if anybody feels they want to just drop out the webinar because they've got other things to go to, please feel free to do so. We'll be in touch with you all afterwards anywhere with a link to the recording and to the slides. Peter.
Thanks, Andrew. Just quickly, there were a number of questions and answers, and as Andrew's been going, I have answered a few of them. There's a few more that have popped up, and I'll try and answer them uh, this way once we get to them. So I think if we just go through some of the questions that are that we were sent and make sure we've covered them. There's a question here. Can you discuss inheritance from parents in Australia and how to bring them over in the most tax effective way? Here, it's really important that a proper advice is received. You need to get advice both in definitely in Australia. If your parents live in Australia, you'll need to get advice in Australia from an accountant and from a lawyer who understand the Israeli side. There are ways of getting this 100% wrong, and there are ways of fixing it. So really important. The discussions I'm having with younger people making Aliyah are normally around have their parents thought of and ensured that their estate plan and their plans for the future are not affected now by you. So all I can say there is get advice. If somebody's asked how do they reduce tax in Australia for foreign residents, you've got to get proper advice. It depends on structure. It depends on a lot of things. That's not something we can answer here at the on the seminar. Somebody's asked a question. There's a couple of questions here about returning Israelis. Please understand that you are in a separate boat. Firstly, the Aliyah Shaliach or the Shlichim in Australia, their job is to help people make Aliyah. Returning Israelis are not making Aliyah. So they can help you to some extent, but not fully. You need to get your advice. You may, I've seen some people who get their 10 years exemption period, other people who get less. Again, it's dependent on each individual. So you'll need to get specific advice for yourself. But you are in a separate boat. A lot of the things we talk about in terms of the tax, definitely after the 10-year period, are the same. So some of that advice is covered. I talked about that. There's a question here, Andrew. Does it make sense to put money in term deposits? Do you want to quickly answer that while I look at the next ones?
Yeah, I'm sure. Thanks, Peter. Depends on your time frame, doesn't it? Interest rates are heading down in many major markets like Europe, Switzerland. In Israel, they're expected to probably start heading down soon as well. So term deposits give interest, but interest that's probably going to decline in the coming years. And of course, as any seasoned investor knows, over time, a diversified portfolio can give significantly better returns than money held on deposit, which just gives basic interest. So for emergency money, a term deposit possibly, but for long-term capital, really not the right place to be, really not the right home for your capital.
Okay. So next one was about somebody making Aliyah and then contracting back to an Australian company. I think I mentioned that, but I just want to make sure everybody's aware. The double tax treaty in black and white makes it very clear that for personal services income, so income for your own work, that is taxable in the country in which you live, not in the country in which you are paid. So the Australian company pays you, you're taxed in Israel, not in Australia. Um, Now, I have had a few cases of people having their own companies in Australia that are continue to work, and they're going to draw a salary from that when they come to Israel. Um, uh, Israel does have rules around foreign controlled entities. So if you have 100% owned entity in Australia and you want to just draw some income from that, that may not work. You need to get advice here in Israel to make sure that that's not going to be a foreign controlled entity. If you've got partners in that business, then it most probably will be okay. But that is something to look at. If you're working for a large multinational out of Australia, no problems at all. I have had people working for government, the Australian government, councils, state government, federal government, and coming here, they've accepted the fact that they're not taxable. I had one case where somebody was employed by a large company and they didn't want to take my advice. They said they needed a ruling. We went to the Australian Tax Office and asked for a ruling, and they said they refused to give it because it's black and white. You are taxable in Israel, not in Australia if you're living in Israel. So it is very, very clear law. On that one, that was covered. That's covered. The same thing applies to doctors. So if you're doing telehealth from Israel, you'll be providing services from here. Just be careful. You may have some VAT requirements. The rules around VAT exports of services are different to what they are in Australia, and you do just double check that with a local accountant. Somebody's asked about estate planning and inheritance. As I said, for your parents, that's got to be looked at. For the people making Aliyah, if you've got assets remaining in Australia, and I didn't mention this in the talk, you'll need to continue having a will, preferably a power of attorney and a power of guardianship in Australia in case you're there when something happens, but definitely you'll need a will in Australia for your assets there. You will need to replicate that in Israel, and you need to make sure that both lawyers know the other exists. We have seen people move from Australia with assets in Australia, go to an Israeli lawyer, and the first line in the will says, I hereby revoke all my previous wills. Their Australian will's just gone into the bin, and that causes problems. So make sure the lawyers know that you've got assets in both locations. That's all right. Um, I've had this, I regularly get asked what's the best method of transferring money to Israel. I'd like to say that the worst method is the banks. They're expensive. They charge a fee and their exchange rate's not going to be good. Some of the private banks may give you a better rate in Israel, so do look at that. But I tend to use intermediaries. There are quite a number. There's a couple based in Israel. There's a few based in Australia. They're all reputable. Well, they should be reputable companies. Just double check. I personally use OzForex. It's just the one I happen to use. It's as good as any of the others, right? And you get a much better rate.
Peter, if I could just jump in
Yeah,
on that one
yeah,
for clients moving portfolios or capital to invest with Pioneer, we get a wholesale banking exchange rate for clients of ours, which is free of any commission from anybody, including ourselves. So we usually get excellent rates for clients of ours in both shekel and US dollars.
great. That's great. Thanks, Andrew. Somebody's asked the question, can you be a tax resident of both Australia and Israel? And the answer is no. The double tax treaty makes it very clear that that is impossible. You cannot be a tax resident of both. If you're an Australian resident now, the moment you become an Israeli tax resident, you stop being a resident in Australia. And if there's a question mark between the two, you work through that. There's a page and a half in my notes from the double tax treaty. You work your way down that double tax, those notes as to try and work out where you are. And the last line is ask both tax officers if you can't work it out, and which is possible. My parents prior to the double tax treaty spent 6 months of the year in Israel, 6 months in Australia. They had a house in Israel, a house in Australia, memberships in both places. It would have been very hard to decide where they were a resident, and they didn't have a pet. So it's sometimes it is difficult. Where it's difficult, it gives you an opportunity to decide where is the best place for you to be a resident. Transferring super, we've talked about. Family trusts, we've talked about. Somebody's asked, should Australians who are approaching retirement age wait until retirement before making Aliyah? The answer is, I don't think that's necessary. You should make Aliyah when it is best for you from a lifestyle choice to make Aliyah. The planning, though, should take that into account. So you may pre-plan to do certain things. Look, there are times where we may delay Aliyah. If you've owned your home for 9.5 years, and you want to make a downsizer contribution, you need to own it for 10 years, you'll wait 6 months to make Aliyah. There are some other instances where, if you haven't sold your home, you wait until you sell it to make Aliyah. So there are some things, but most of your decisions should be based on what your lifestyle rather than the cash. That's nothing. Opening bank accounts we've talked about. Answered that, answered that, answered that. Andrew, I think you've talked about how you protect yourself against exchange risks. So I think we've covered that one. I mentioned foreign controlled entities. We're getting through this. Medicare. When you, as an Australian resident, as an Australian tax resident, you have a Medicare card and you're entitled to Medicare. That gives you free medical treatment at certain levels in hospitals and other stuff in Australia. You are not entitled to use that Medicare card if you are not a tax resident of Australia, even though you may still have a card and your name may still be on it. They don't reissue cards and they don't have a process of taking you off there. But it is actually illegal. You're stealing from the Australian government if you use your Medicare card and you're just come to Australia on a holiday. So please understand that. You should not be using your Medicare card if you're not an Australian resident. You should be taking out insurance for your health when you're in Australia. Um, we've covered those, covered that. Um, um, Andrew, are there any benefits for people over 65 once they make Aliyah? So, is there a pension entitlement in Israel? What happens there? I can say from your Australian pension, if you're on a pension in Australia, you most probably will keep some of that pension, but not all of it. There's rent assistance and other things in that pension, but you do need to get advice on that. Over to you, Andrew, on the Israel
And there's
side.
nothing really too significant for someone who's lived all their working life outside of Israel and then comes as a retiree.
Okay,
Nothing that can, be game changing.
okay. Okay, said, I've been living in Israel but have been registered as an Australian resident for tax purposes. How do I rectify the situation? Okay, so let me firstly say one of the things that happened when the double tax treaty was signed is that the tax office records for both Australia and Israel were open to the other country. And we know that both countries have been looking at the other's tax records. So if you're currently in that situation, assume that soon one or other of those locations, Israel or Australia, is going to come knocking on your door. So it would be a good idea to correct this situation. You should go to your accountant in Australia and fix up your tax returns in Australia and re-lodge as a non-resident. If some of your income was interest and dividends, you may find you pay less tax in Australia. So it may not be a problem. But you've got to also fix it up in Israel. And we've had issues with this where one country will only accept it once the other one has actually received tax returns. So you need to have your accountants in both locations talking to each other. But it is something to fix. Again, do not three-monkey this. This is something that needs to be sorted through. Okay, so there are all the previous ones. Just
Peter, I've answered some of the ones directly that were posted on the group, so maybe you can just pick the rest up afterwards.
okay. I think don't think there's anything there that we haven't covered. Yeah, it looks like it.
Uh,
If we buy, sorry, just look at this last one. If we buy property to live in Israel before making Aliyah, did you say we pay capital gains tax in Australia? If so, is this only when the property is sold? No. If you buy a property in Israel before you make Aliyah, that do keep all of the records, convert them to Australian dollars, so you have a cost base. When you cease to become an Australian resident, you are subject to capital gains tax in Australia on the difference between the value of the property on the day you make Aliyah to against that cost base. And that valuation change is based on the Australian dollar difference. If it's 3 months, 6 months, it's not going to change. But if it's a year, 2 years, you could have a sizable capital gain. But as I said in my talk, I wouldn't let that stop you buying something, because if you do have a gain, you're better off paying 24% of the gain than 100% of the gain. Okay. I think that sort of covers it.
Yeah, so I wanted to thank everyone for joining us and Peter as well. We will be sending out from our offices a link to a recording for anyone who wants to rewatch it. and the opportunity to say if you'd like to get slides from either my presentation or Peter's. If anybody wants a direct follow-up consultation, either with Peter or myself, we're both available in the coming weeks. I'm happy to speak to anyone who needs some guidance, some really important decisions that people need to make. You know, whether you've made Aliyah or you're still planning it, your financial security, your peace of mind, the success of your Aliyah depends on making smart, wise, informed, correct decisions about what to do with your money, what taxes you should be paying and shouldn't be paying, how to structure your affairs. Peter and I, we've got decades of experience each, and therefore between us, it's probably a very large number, and we are both here to help you with that in the coming journey ahead. So thank you very much for joining us, Peter. I'll leave it to you to finish up.
Yeah, I just say don't contact me in the next week. I actually leave Israel on Sunday, and it'll take me a few days to get back to Australia and then recover from jet lag. So please feel free to contact me after the 14th. And I'm happy to help. The way I operate, for anybody who's not spoken to me before, I'm happy to give a 1 hour free Zoom or face-to-face advice. After that, however, we all need to eat and feed our staff, and our grandchildren. So there will be some fees, but definitely that first hour, happy to help and work things through for you. Okay. I think again, thank you all. Thank you, Andrew. Always a pleasure to chat, and we'll speak to you soon.
Bye bye.
Bye bye.